Welcome to the AI financial debate. Please remember this is an AI-generated simulation for educational and entertainment purposes only. This is not investment advice. Always do your own research. Welcome to the debate. Today we're diving into one of the most polarizing cases I've seen in a while. InsureMe Insurance Brokers Limited. This company is a fundamental challenge for any investor, really, because it's two things at once. You've got a traditional, highly profitable, frankly a bit boring insurance brokerage core. But that core is funding a high-growth, cash-burning financial tech subsidiary called DIGIS.
And that's where the whole story gets complicated, isn't it? The central controversy is just its valuation. How on earth do you value a company when its consolidated numbers are, frankly, crashing? But the story is all about this aggressive, futuristic transformation.
Exactly. So the question is simple. Is today's high price a fair entry point for future explosive growth, or is it a dangerous speculation that completely ignores a collapse in financial quality?
Right.
Now, I'm staking my claim on the side of optimism. I believe if you look past the noise of those consolidated figures, you find a classic fast grower that's shielded by this enormous cash safety net. The upside potential is huge.
And I have to come at it from a completely different angle. Look, the narrative of boring business funds global tech expansion, it sounds great. It's a great story. But complexity usually just masks a risk. And in this case, it's masking plunging quality. When I see a share price of 442 LKR, I see pure speculation. You're asking investors to pay a PE of somewhere between, 73 and 77 times, trailing earnings for a company whose fundamentals are visibly falling apart. For me, it's structurally overvalued and a hard pass.
Okay, that's 77 PE. I get it. It's a headline figure, and I see why you'd start there. But I would frame it very differently. That metric is, I think, highly deceptive. It's the key analytical error most people make here. This isn't one simple company. It's a cash cow funding R&D. If you just peel back the layers and do a basic sum of the parts analysis, the picture changes entirely. The insurance broker is making significant profits, but they're all being obscured by the losses from the tech side, from DIGIS. And we know those tech losses were 14.7 million LKR in just the first half of fiscal 26.
Right, and accelerating.
Well, sure, but if we strip out that loss, if we just look at the core business and annualize its profit, the core brokerage division's EPS comes in around 28 LKR. That means the stable, growing brokerage is actually trading at an implied PE of only about 15. 15! For a market leader in insurance services, that is a very, very attractive multiple. You're buying that strong core business at a reasonable price, and you get the massive global upside of DIGIS as well as a free lottery ticket.
A lottery ticket.
And let's not forget the balance sheet. 73 LKR per share in pure cash, and the company is virtually debt-free. That creates a rock-solid protective floor for the whole investment.
I'm sorry, I don't buy that kind of creative accounting. You're asking us to value the company based on pro forma earnings that require us to just strip out genuine, ongoing, and, as I said, accelerating expenses that management chooses to incur. You can't just wish away the losses that are central to their entire growth strategy.
It's an investment, not a loss.
It's cash going out the door. And let's talk about the quality issue, which is my real concern here. Forget the PE for a second. Look at the efficiency of their capital allocation. Return on equity is the true litmus test, isn't it? And it has plummeted. In 2023, the ROE was an excellent world-class 53%. By 2025, it had collapsed to a dismal 8.4%. When a business sees its returns on capital erode by 85%, it is destroying shareholder value, period. Growth that requires such a massive destruction of capital efficiency it's bad growth.
But it's temporary.
And that leads right back to the valuation you're defending. Paying 442 LKR for a company with a single-digit ROE is pure, unadulterated hope. When I run the numbers on true intrinsic value based on sustainable owner earnings and applying the high discount rates you need for this region, my conservative estimate puts the value somewhere around 162 LKR per share. This stock is trading with a massive negative margin of safety.
Okay, that brings us right to the first battleground then. This disagreement over the cash and what this CapEx really is. 162 LKR is a profoundly bearish number. And the only reason it isn't lower, by your own admission, is that immense cash reserve. You see the 73 LKR per share as fuel for a furnace. I see it as a structural safety floor.
Yes, and I want to address that. My 162 estimate is based on owner earnings, where we try to find the real cash flow available to shareholders. And what we find is alarming. It is a furnace, and the burn rate is accelerating. DIGI's losses were $12.3 million in fiscal 25, and as you said, $14.7 million in just the first 6 months of fiscal 26. The cash pile is funding this. More importantly, the reported net income of $12.1 million in fiscal 25, it did not translate into real cash for owners. Our calculation of owner earnings for that year is only about 7.1 million LKR. That gap is significant, and it confirms management is reinvesting every single dollar of profit internally, often by capitalizing it. And you can see that capitalization clear as day on the balance sheet. The intangible assets from software development jumped to $34.5 million. This accounting move, capitalizing these costs instead of expensing them, is exactly why the reported net income looks higher than the real cash flow. The business is going from a cash generator to a capital-hungry entity, and it's consuming cash under the guise of R&D.
That's a compelling point, but I think you're applying a framework that's designed for, a mature, stable utility to a company that's in the middle of a massive pivot. We have to distinguish between maintenance CapEx and growth CapEx.
It's still cash out.
Of course, but that $34.5 million in intangible assets, that is pure growth capital expenditure. It's the investment needed to go from being a traditional broker to a high-margin, scalable software exporter. It's a one-time strategic cost to get to scale. If you define owner earnings by penalizing all CapEx, you will always undervalue a high-growth company in its investment phase. This earnings distortion is temporary. It's masking the robust $29.3 million profit the core broker made in just the first half of fiscal 26. The engine is still humming.
The engine is funding the fire.
And let's get back to that protective floor. Even if we accept your bearish scenario, Digi gets shut down, the whole tech investment is a write-off. The conservative value of the core brokerage is still substantial, around 336 LKR per share. That cash means the downside risk is significantly protected against your price target. The cash minimizes the fall while the software preserves the massive upside.
Okay, but minimal downside protection doesn't justify the immense execution risk here. We have to move beyond the accounting and ask if this business actually has a sustainable competitive advantage. I'm just not convinced by this fast grower story because I don't see a moat being built.
I disagree fundamentally. I think that view misunderstands the mechanics of B2B insurance. InsureMe operates on a really sophisticated razor and blade model. The B2B brokerage is the razor. It locks in large corporate clients who need complex service, which creates high switching costs. The tech, the DIGIS platform, that's the blade. It gives them a structural cost and service advantage over slow, traditional competitors. That 19% revenue CAGR isn't luck. It's validation that the model is working.
But the margins.
And the margin compression you keep mentioning, net margins collapsing from 19% to 3%, it's not weakness. It's a calculated temporary result of high-velocity investment. They're scaling DIGIS globally, into Singapore, into MENA. They're paying referral fees. That's a deliberate, necessary cost to get to critical mass.
That volatility and that drastic margin collapse, to me, that indicates poor operating leverage and huge execution risk, not sustainable growth. The instability of earnings is a major red flag. Net profit crashed from $56.2 million in 23 to $12.1 million in 25. That volatility confirms management is paying an exorbitant price to chase growth that is demonstrably failing to translate into predictable cash-backed profit. And the moat is still narrow. B2B might be sticky, but the broader brokerage market is a commodity space. For retail customers, switching costs are near zero. So if they are consuming all this capital to build intangible assets, but the result is an 8.4% ROE and volatile earnings, they are paying a premium to enter a low-barrier market. That capital should be creating a durable advantage, and the financials say it is not.
Ultimately,
I think this whole debate just boils down to valuation justification, where we're applying different probabilities to the future. My conviction is driven by the potential for explosive margin expansion from a software exporting model that has virtually unlimited scalability once this investment phase is over.
And my conviction is driven by the enormous downside risk if management fails to execute. We have to look at what happens if that projected bounce back to $60 million in profit. What if it's just a promise? What happens if the tech growth stalls and the market decides this is just an overinvested, volatile brokerage? It will revert to a conservative broker multiple, 10, maybe 12 times PE. If you apply a 12 times multiple to even a recovered earnings estimate, the stock price could crash up to 80% and still only be trading at what the market thinks is a fair price. The price today, $442, requires perfect execution.
It requires successful execution, not perfect. And it ignores the probabilistic upside, which is immense. We're talking about a company trying to export high-margin, scalable software globally. This is an asymmetric bet. If the optimistic case plays out, if DIGIS accelerate and those high margins kick in, consolidated earnings could easily hit that 60 million LKR projection, leading to an EPS north of 40. Give that a modest tech multiple, say 25 times, and the potential price is over 1,000 LKR, more than double today's price. That risk-reward is exactly what makes it so compelling. And given the downside protection from the cash and the leverage from high-margin software, the forward-looking PEG ratio of 1.55 is entirely acceptable. We are pricing in the growth, not the temporary earnings distortion.
I just reject that premise. A 1.55 PEG is not acceptable for a business with an ROE of 8.4% and chronically volatile earnings. The market is supposed to price in certainty and predictability. This offers none of that. The high return required to justify this risk demands a price far, far lower than 442.
So, to summarize my position, I see InsureMe as an excellent speculative buy. The core broker is strong, it's growing, and it's trading at an attractive implied 15 times PE. The investor is protected by cash and zero debt. The whole thing hinges on management's ability to turn the DIGIS cash drain into a profitable global software exporter. The asymmetrical risk-reward profile, for me, warrants a speculative buy.
And my position remains a hard pass. The current price is based on hope and promises, not on the financial reality of a collapsing ROE and an erratic earnings track record. We are paying a premium price for a company showing massive capital inefficiency and no clear moat. We should buy wonderful businesses at a fair price. This is an average business priced like a superstar. I'd avoid this speculation and wait for an investment that actually offers a margin of safety.
Ultimately, this case really highlights that InsureMe is less about basic accounting and more, it's a philosophical decision on time horizon and risk tolerance. It's up to the investor to decide if they trust management to stop the bleeding and convert that investment into real, sustained revenue.
Indeed, investors have to choose. Are you focused on the tangible cash in hand today or the highly probabilistic cash you might have tomorrow? And there's clearly much more analysis needed on how those intangible assets will or won't translate into future profitability.